Welcome to Minc Market Education. My name's Stuart McClure and today we're looking at collars. So what is a collar? A collar is a moderately bullish market strategy involving both options and stock. It's very similar to a covered call strategy, however we have protection. So it is a covered call with a bought put. It's a useful strategy when you can't afford to lose much on a particular trade or on your investment, but you still want to participate in the upside of the market over a longer period of time, perhaps 12-18 months. Collars generally don't make significant returns. They're not like your bull calls or your sort of more exotic option strategies. A return of 20% per annum would be outstanding. Now, you do have to wait till expiry. This is one of the disadvantages of the strategy, and the generally expiry is 12 to 18 months to really benefit from the strategy. However, considering how low a risk the strategy is, which can be extremely low risk, I find that the strategy is very worthwhile. So let's have a look just in a little bit more detail in terms of the construction of a collar. So to construct a collar, essentially what we're doing is we're going out and purchasing shares. We sell a call over the top of the shares, and at the same time we buy a put. So very, very simple strategy. Buy a put, sell a call, and buy the stock. Now, what are the advantages of trading a collar as opposed to some of the other strategies like a covered call? We have a defined maximum loss. The put option protection, essentially it protects your investment from a significant loss. You're only risking a very small portion of your actual total account. It's the difference between the bought share price and the bought put. So another advantage is the fact that you actually can leverage right up to 100% of the value of the put. So this means it's risk-free leverage as well. If the market falls, you've got the put in place. You can't lose any more money for taking on a margin loan account utilising this strategy. The only difference would be you do have to pay an interest rate, a cost to do so. So what are the disadvantages of the strategy? Well, it has a defined maximum profit. When it gets to a certain point, you simply cannot make any more money out of the strategy. That's because we're selling a call at a high strike. When the share price reaches that high strike, our profits top out and we stop making any more money. So usually it's a debit to enter the strategy, so it does actually cost us money to set up this sort of strategy, generally speaking. And usually you do need to wait 12 to 18 months to actually collect your profit, your maximum sort of return. The other thing to consider is returns are generally fairly low with this strategy. Because risk is so significantly low, a 20% per annum return on a trade like this would be exceptional. We're generally, because we're taking on a very, very small portion of risk, you would expect to see quite small returns at the same time. So you would look at this strategy for more suited to investors and long-term investors rather than traders. So here we have the payoff diagram for the strategy. You can see on the left-hand side of the screen, or bottom left, we have a maximum potential loss, and on the top right we have a maximum potential return. And as the share price rallies, our potential return, or our profits, increase. So what we want to see is the share price move up to our sold call level. Time value is also very important to analyze in this particular strategy. The sold calls in the strategy will actually benefit from time decay, where the bought puts will actually be detrimental by time decay. So what we find is when the trade is winning, essentially time decay works in your favour, and when the trade is losing, it's working against you. Now, there's essentially three outcomes for this particular strategy at expiry. One is the share price is trading somewhere between your bought puts and your sold calls, which essentially means both of those expire worthless. You're left with the stock, and your profit's going to be any difference, profit or loss, will be any difference between the current share price and the price you paid for it. If the share price is above, obviously you're going to make money out of it. If it's below, you're going to lose money. You're going to close out of the position at that time and set a new one up. Outcome number two, the share price is trading above your sold call level. In this scenario, you're going to exercise your calls, your puts are going to expire worthless, and you're going to obviously sell your shares at the sold call value. The profit will be the difference between the sold call and the price you paid for the shares. The third outcome is the shares are trading below your bought put level. In this scenario, the shares could go all the way down to zero, it doesn't matter. We would exercise our puts, we would sell the shares at the price, at the put strike price, and our sold calls would expire worthless, and we'd liquidate the position for our maximum potential loss, which, depending on how we structure the trade on day one, could be at the price that we paid for it, and we may only be paying the debit to get into the trade, or it could be a capital loss on the trade. It really depends on where we position the strike prices and the construction of the trade originally. So that brings us to the end of the collar strategy. I hope you have quite a good understanding now of how they work. I'd recommend looking at some of the other strategies like covered calls, just to get a bit of an idea as to how that works in comparison, and also watching the webinar on option Greeks in terms of the construction of the trade. Thank you very much.